Welcome to this explainer on the core components behind macro. Today, we're unpacking the IMF's macroeconomic framework. And look, instead of getting bogged down in dry theories, I want you to think of a national economy like a massive interconnected engine. Literally every gear, every belt, and every single drop of fuel affects how the whole machine runs. So, here's our roadmap for dissecting this engine today. We'll start with the macroeconomic framework explained, then move into the fiscal sector, looking at revenue and spending. After that, the external sector and its global connection, followed by the monetary sector where we track the money. Finally, we'll cover debt dynamics and sustainability, before connecting all those macroeconomic dots at the end. Section 1. The Macroeconomic Framework explained. So what exactly is this framework? Well, it was developed by the International Monetary Fund, and what it does is combine theoretical macroeconomic principles into this really consistent 360-degree overview of an entire economy. Instead of treating things like public economics, international trade, and banking as separate, isolated silos, this framework basically smashes them all together. And why does that matter to us? Because having this comprehensive view is exactly how world leaders and analysts figure out whether a country's engine is thriving or, completely stalling out. Which brings us to our ultimate scorecard, gross domestic product, or GDP. But you've got to be careful about which version you're looking at. Nominal GDP measures a country's output using current market prices. But because it doesn't adjust for inflation, nominal GDP can actually look like it's growing just because prices went up, even if the country literally didn't produce a single extra item. Crazy, right? That is exactly why we rely on real GDP. By using constant prices from a fixed base here, real GDP strips away all that inflation distortion and shows us the true production volume and actual economic growth. Section 2. Fiscal Sector. Revenue and spending. Okay, so a huge part of government revenue, which is basically the primary fuel for this part of the engine, comes from indirect taxes, and how they calculate these might actually surprise you. Let's take an imported can of Pringles, for example. It doesn't just get a simple flat tax. These taxes actually compound. So if the base import price is 100 taka, the government first applies a 10% customs duty, bringing the value up to 110. Then a 10% supplementary duty is applied, but not on the original 100. It's on the new 110, which pushes the value to 121. And finally, a 10% VAT is tacked onto that cumulative 121. It's this cascading layer of taxation that rapidly multiplies the revenue generated from just a single product. On the flip side, what does the government actually do with all that fuel? Well, they burn through it via expenses, which break down into a few main categories. You've got operating or revenue expenditure, which covers day-to-day stuff like public salaries and subsidies. Then you have interest payments on both domestic and foreign debt. And finally, development expenditure, which is spending on things like building roads and bridges or net lending. The catch here? Total expenditure almost always exceeds total revenue, which leaves the government with a persistent budget deficit. It's just a structural reality of the system, meaning they constantly have to figure out how to finance that gap. Section 3. External sector, the global connection. Now, let's look at how the balance of payments separates money flowing across borders into two very distinct buckets. First up is the current account. This tracks your daily money flows, so the trade balance of exports minus imports, payments for services, and crucially, workers' remittances sent back home. The second bucket is the capital and financial account, which tracks those long-term investments like foreign direct investment and foreign loans. When you combine these two accounts, you get the overall balance. If it's a net surplus, you're adding to your country's foreign currency reserves. But if it's a deficit, those reserves are draining. And monitoring those reserves is absolutely critical. We measure reserve health by looking at how many months of imports a country can actually afford. If a country's foreign reserves drop below the ability to cover 3 months of imports, that economy becomes highly vulnerable to external shocks. It's literally like a country rapidly running out of fuel. We've seen this catastrophic vulnerability play out during global crises when import prices for absolute essentials like wheat, soybean, and fuel just skyrocketed. It drains reserves and forces nations to seek emergency assistance. Section 4. Monetary sector, tracking the money. To really grasp the money supply, we first need to master the difference between a stock and a flow variable. Think of a bathtub. A stock variable is the total water level in that tub at a single specific moment in time. A flow variable, on the other hand, is the water actively pouring from the faucet over a period of time. So the total money in an economy at year-end, that's a stock variable. But the new credit issued throughout that entire year, that's your flow variable. To figure out next year's stock, you just take this year's stock and add the new flow. So what exactly makes up the total money in the economy? It's known as broad money, or M2, and this is where the engine's gears truly interlock. Broad money is a combination of two things: net foreign assets, which are directly tied to that overall balance from our external sector, and net domestic assets. Now, net domestic assets include domestic credit loaned out to the private sector, plus claims on the government. Remember that persistent budget deficit we talked about earlier? Well, when the government borrows from banks by selling treasury bonds to finance that deficit, it shows up right here. Section 5, Debt Dynamics and Sustainability. Now, the breakdown of national debt interest might seriously surprise you. When we hear national debt, we usually picture massive foreign loans. But look at the interest payments. Domestic borrowing options like national savings certificates and treasury bonds often have much higher interest rates, sometimes around 10%, compared to foreign loans from institutions like the World Bank, which might only charge 1 or 2%. Because of this massive rate difference, a staggering 90% of a government's total interest payments can actually end up going strictly to domestic debt, with just 10% going to foreign lenders. And the burden of this debt is heavy. When you combine those interest payments with amortization, which just means paying back the actual principal amount of the external loans, debt service becomes a massive drain on the engine's power. In fact, total debt service can consume up to 35% of total government revenue. Think about that for a second. More than a third of the government's entire income from taxes and fees vanishes immediately just to service existing debt. That leaves way less room to fund schools, healthcare, or crucial infrastructure. Section 6. Connecting the macroeconomic dots. This right here is the real power of the IMF's framework: sectoral linkages. All the gears are connected. A fiscal budget deficit requires financing, which directly links to taking foreign loans in the external sector or printing money in the monetary sector. If the fiscal sector runs a budget deficit, it literally forces gears to turn elsewhere to fill the gap. The government either has to take on foreign loans, impacting the external sector and increasing debt dynamics, or it has to borrow domestically from banks, altering domestic credit in the monetary sector, essentially printing money. A shortfall in one area demands an equal reaction in another. Now that you understand the hidden mechanics behind the macroeconomy, you can start to see the invisible strings connecting every single policy decision. So I'll leave you with this to ponder. If a sudden shock hits, say a massive drop in exports or a sudden spike in global interest rates, how will that single event cascade through the fiscal, monetary, and debt gears of your country's economic engine? It's a giant puzzle, and that is the power of the macro framework. Thanks for joining me for this explainer.